Natural gas prices have been on the rise again in recent days, but what's really driving this move? Let's break it down into two sides of the story, fundamentals and technicals. So, fundamentally, the story flipped almost overnight. Weather models turned sharply colder for mid-November, especially across the south and east. That's a big deal because we're now entering the heating season, and even a small drop in temperatures can translate into a major jump in gas demand. And the market reacted immediately. Traders started pricing in that colder pattern, with buying accelerating as fresh model runs confirmed it. Suddenly, those bearish storage headlines didn't matter so much anymore. Yes, inventories are still 5% above the 5-year average, but the focus has shifted from what we have in storage to what we might need very soon. On top of that, LNG exports have quietly hit near record highs. Feed gas deliveries are running strong, with global buyers, especially in Europe and Asia, drawing heavily on U.S. supply as winter nears. U.S. LNG export flows rose 13.5% week over week to 16.8 billion cubic feet per day, providing additional demand-side support. That export strength is providing a solid floor under the market, offsetting mild domestic weather and keeping prices well supported. Nevertheless, fundamentals may soon pose a real headwind to any further upside. Traders seem to be completely overlooking one critical fact: U.S. dry gas production just hit a record 110 billion cubic feet per day on Monday. That's an all-time high, and it strongly suggests this price spike is being driven more by speculation and short-term momentum than by genuine supply tightness. On top of that, the active rig count continues to climb, reaching a 2-year high of 125 rigs. That's a clear signal that production growth could accelerate even further in the weeks ahead, adding more pressure to prices once the weather premium fades. In other words, while the rally looks impressive, the underlying fundamentals don't really justify it. This surge feels more like a sentiment-driven squeeze than a sustainable trend. Now, switching to the technical side, that's where things really get interesting. December futures just broke out from a tight consolidation zone, blasting through the $4 to $4.10 resistance band. That breakout unleashed a wave of momentum buying, algos, funds, and retail traders all piling in once key levels gave way. Momentum indicators are flashing hot. The RSI has been in overbought territory for 2 straight sessions, signaling the rally might be overextended in the short term. But here's the twist: as long as prices stay above $4.10, bulls still control the field. If this strength continues, the next upside targets sit around $4.40, and a sustained close above there could open the door to something bigger, possibly a winter run that catches a lot of traders off guard. But, and it's a big but, if the weather models suddenly flip warmer or if we get a surprise storage injection later this month, this market could unwind fast. A sharp correction back toward $3.80 is absolutely possible. The question now: will this rally hold as the cold sets in, or are we setting up for another classic widowmaker move, one that lures everyone in, only to pull the rug out a week later? Let me know in the comments, what's your take on this situation, and check out the ads to support the channel. See you in the next one.